Buffett, and I head up the outreach program at Buffett Investments. This evening, we will have a chance to speak to Mohnish Pabrai, known initially perhaps for his lunch with Warren Buffett alongside Guy Spear in 2007. Monish has actually been investing capital in public equities for a much longer period than that, I think since the mid-1990s. For the first few years of his investing career, Monish generated returns of over 70% compounded annual growth rate, investing in funeral homes when most people are investing in tech stocks during the dot-com bubble. Monish actually comes from a computer science background. So he's born and brought up in India, studied computer engineering at Clemson University in the mid-1980s. And following his education, he worked for a few years for a company called Tell Labs before launching his own IT enterprises. In the mid-1990s, Monish came across the value investing philosophy of Ben Graham, and from there has effectively pivoted into a very successful investment career. He sold his business, I believe, in 2000 for $20 million, if I'm not mistaken. Over the years, Monish has run over $1 billion in AUMs and has more recently launched the Pabrai Wagons Fund. So we hope to talk a little bit about that as well when we get the chance. This is a fund which is long only, globally opportunistic, and is concentrated between 15 and 25 businesses in its portfolio, which you or I can invest in. So over the years, Monish has written a couple of investment books. Perhaps the most popular one is The Thunder Investor, which a lot of people know of, especially within the value investing community. But his earlier book, and perhaps for me, the more interesting book, is called Mosaic, Perspectives on Investing. But apart from the tech side, apart from the business side, and apart from investing, perhaps the most important thing Monish might be working on is his foundation, Dakshana. The goal of this foundation is to break the shackles of poverty using education. Within it, using extremely little pools of capital, he's educating some of the best and brightest minds in India, coming from impoverished families, and managing with that training and education to beat the odds to get him into the IITs around the country. Of course, with the IIT DNA being somewhat based off of MIT, this is an idea that's close to our heart. And I hope, Monish, that we can delve further into it during the conversation. On a more lighthearted note, Monish has received a lifetime ban from a casino in Las Vegas for playing blackjack and winning without counting cards. For those of you who have seen the movie 21 and know of Professor Ed Thorpe here at MIT, you know that blackjack too and getting kicked out of casinos is close to some students' hearts. So that's just some really cool information. Now for you, our students, for those of you who may not be aware, the Buffett Fund is a non-profit long-short equity hedge fund that is run by undergraduate and graduate students following the completion of an educational program. The fund itself provides a hands-on learning experience on how to look for and invest in companies, and has been developed in line with MIT's ethos of mind and hand. We're just getting started with this fund. And so for those of you who've not looked into it, please absolutely do. It's a life-changing opportunity. Now, I wanted to give a special thanks to Francis Borrego and the Career Advising Professional Development team for their efforts in organizing today's event. This event is co-hosted by the Buffett Fund and the CAPD team. I especially want to thank Telis Bertsekas, head of the MBA Finance Certificate, lecturer, and the champion behind the fund for his support in making this happen. I also want to thank the Investment Management Club, VCP Club, the ETA Club for all of the support. For the call today itself, will be with the opening remarks, I'll hand over to Monish to say a few words. But after that, we'll kick off into a Q&A. I'll ask a couple of questions just from an introductory perspective, and then we'll give it over to the students. Monish's assistant has specifically asked us to make the questions as difficult as possible. I sent through a list of questions, and I think I've now had to draft up entirely new questions because he's refused to see any of the questions that he's received. So there's a lot we stand to learn. It is absolute honor for me. It is over a decade of research into this world. So for me, this is an unbelievable, life-changing opportunity. So Monish, over to you, and thank you so very much for giving us this time.
Well, Kishan, it's a pleasure to be here, and thanks for having me. It's great to be here, and I'm more curious to hear about what you guys have on your mind. So I'll just keep the preamble short. Uh, Last year, Buffett in his letter had highlighted that in a 58-year uh, run at Berkshire, there were about a dozen investments that had really moved the needle, had made an impact on, and actually led to what we recognize as Berkshire today. And so Buffett said it was approximately one good investment every 5 years on average. And both Buffett and Munger were very hardworking. Warren is still very hardworking. Uh, Charlie was uh, still placing buy orders on a stock 6 days before he passed away. And I think even the day off or the day before he passed away, he was trying to close some grant to some institution. So he was, working till the end. And but when you look at these two really brilliant off the charts minds, 1 plus 1 becoming 11 when they work together. Um, And when you consider that with them turning over as many rocks as they did and working as hard as they did, it seems strange that they could only find a good idea every 5 years. And so the question is, why is that? Why is it so hard for people who are so talented, and what hope is there for the rest of us? And these dozen investments that Warren didn't name, but we can make a guess on, are companies like Coke, See's Candy, Burlington Northern, the hiring of Ajit Jain, and Cap Cities, ABC, and so on, See's Candy, and so one of the questions that I think comes up is that why why would it take why would there be just 12 outstanding investments and so many mediocre ones and several poor ones from these two geniuses who worked so hard and who are the best we've ever had? And I have some thoughts on that. It's an area I'm still kind of um, feeling my way through, if you will. Um, but one of the things about investing is that we have to stay within our circle of competence. And when we start out young, by definition, the circle of competence is going to be pretty narrow, and it might be initially limited to a subset of products and services that you directly use. And then, of course, as you get to know the way the world works, uh, by osmosis, that circle expands. And as it expands, and as you learn more things, um, you're able to uncover more opportunities. But there's no real easy way, or I would say prescribed way, to increase that circle. And and this is definitely an area where you want to be an inch wide and a mile deep, rather than an inch deep and a mile wide, because then you would have no competence if you were an inch deep and a mile wide. So if we look at the investment that Berkshire made in See's Candy. Um, See's Candy was a really quite a stretch investment for them. One of the first times that Warren paid 3 times book value for a business. The family was looking for $30 million. Berkshire offered 25 million. And they also told the family at 25 million and $1, they would walk away. And thankfully, the family accepted their offer, and Seas became part of Berkshire Hathaway. Both Warren and Charlie have said that they were at that time barely smart enough to buy Seas. And it was actually quite dumb not to have been willing to pay up for a business like Seas Candy. And they didn't realize how good a business it was till they had a few years of experience observing how the business did. And they got a very big education on brands and pricing power over a few years. So Warren famously delegates, it's delegation to the point of abdication, as Munger says. With Seas, the only area that he got involved in was on January 1st, he raised prices on the candy every year. And so he basically had them send them the price list, and he would scratch out all the old prices and put in all the new prices and tell them, okay, this is the new prices for the year. And those prices were being raised at significantly above the rate of inflation. And what they observed was that the pounds of candy sold grew on average from the time they bought Seas till about today. It's grown at approximately 1.5 or 2% a year. And which they actually found quite stunning, because they were, putting through 10, 15% price increases when inflation might be 3, 4, 5% or something. So it's significantly above inflation. And the customers didn't protest. And it surprised them. It surprised them how much they were able to raise prices. And actually, if you look at Seas is very heavily a California company. If we look at California GDP growth in that period from, let's say, the mid 70s to, let's call it 2000, if you look at that 25-year period, California GDP probably grew at a faster rate than US GDP. And it might have grown 4 to 5% a year, at least in the 70s and 80s. So Seas was growing below California GDP in terms of volume growth. It was growing ahead of California GDP from a revenue point of view. And part of that might have been the very heavy price increases they were putting through, but also they were dealing in box chocolate with dedicated retail outlets, which is a very unusual formula, and a formula they have found very difficult to replicate in other locations. They've repeatedly tried to expand Seas to other locations, and most of the time they have failed. So even today, it is heavily a California story. But they got a big education in brands from owning Seas. And the investment in Coca-Cola, which came about 13 years after the Seas investment in the late 80s, would not have happened if the Seas investment hadn't happened. So in 1988, Berkshire Hathaway put 1/4 of its entire book value into Coca-Cola. It was a huge bet that they made on Coke. And they were very confident about that bet. I think that the time it took to learn to make that bet might easily have been 5 or 10 years of ownership of C's, at least 5 years. So you would have gone into the 80s. And then to compare and contrast a Coke to a C's is another exercise that would have taken them some time, because these are not quantitative issues. These are very qualitative issues you get into. And even though we think Coke is a product we are very familiar with, and it appears to be a relatively straightforward, simple business, it's actually a very complicated business. Even today, so if you look at Coca-Cola today, it was founded in 1886. It's 138 years old. Um, Even after 138 years, it is an emerging story, and with emerging market growth kind of numbers in a number of countries. And even in some countries, if some areas have matured, there are other areas which are very embryonic. So even after 138 years, Coke is not a mature company. It's still growing and it's still expanding. And it's actually more than 100 brands. And the flagship brand still makes up probably 70-80% of the pie. Even after 138 years of all these different acquisitions and different brands and different things they brought into the tent, the core product remains a very central part. So understanding Coke to the point that a insurance company would put a quarter of his book value into it and consider it a total no-brainer bet, um, is not something that would happen in a month or 3 months or something. So basically, the circle of competence they had went through a very significant shift because of the C's acquisition. And of course, Coke and C's are very different in the sense that Coke travels really well. C's doesn't travel. And Buffett has said that one of the advantages Coke has is that it doesn't have an aftertaste. We cannot consume endless amounts of chocolate. After we consume some chocolate, our propensity to consume more chocolate goes down. But with Coke and other products they have, that propensity to have it on a very regular basis doesn't go down. And so you get to some remarkable statistics in terms of per capita 8 ounce servings per year in different countries and so on. So, and if you look at a business like Burlington Northern, the railroad. So for the longest time, Buffett and Munger were very negative on railroads, rightfully so. It's a very regulated industry. It's very high capital investments. You have to take loads of toxic chemicals, which could cause you a lot of problem if there's a train derailment or something. You can't refuse shipments of chlorine or something because you're concerned about that, and you don't get paid extra for it. So basically, because you're a common carrier, you have to transport those things at published prices of other commodities and so on. But again, they realized after studying it for a while that there'd been a number of changes, and they were actually late to the party. So, for example, the change from single decker to double decker trains, where they double stacked the containers, and redoing the bridges so that the taller trains could pass through, was a project that took many years to get done, but it gave the rails a huge advantage. And similarly, there were a lot of advances that came about in terms of efficiency of labor, and when diesel prices or gasoline prices start going up, then rails become a lot more competitive versus trucks. And so again, it took them a few years to understand that there had been a big change in railroads. And they acquired Burlington Northern. They first bought the stock, but they acquired the entire business in late 2009. And again, that was another example of something that took several years. So I think that when you look at investing, when we look at investing, um, what we are looking for is, so when they finally figured out Burlington Northern, they had an edge which the rest of the world didn't have. And when they figured out Coke, they also had an edge that the rest of the world didn't have. Coke was at a single digit trailing multiple. It had two very gifted managers who were running the place. They had started to transform the way they were allocating capital. They were shedding all the non-core businesses. Coke had bought movie studios and shrimp farms in Thailand and all kinds of things under the sun, which were totally useless, unrelated, very poor businesses. And they were shedding all of those. And it became a buyback machine. And so all those different kind of factors coming together became what Charlie would call a Lulapalooza. And 1 + 1 becomes 11. And it led them to understand that there was a huge differential between where the company was going to be, what it was going to generate in terms of growth and cash flows in the future versus the past. And the same with railroads, right? I mean, they saw a huge delta. Similarly with the utility business under that leadership with Greg Abel and Dave Sokol, or like Ajit Jain coming on the scene, running insurance. So each of these things was a big aha moment. And in an investing lifetime, if we end up with 2 or 3 of these big aha moments, we're doing pretty well. And so investing is a game where there can be long periods where there's nothing interesting. And then suddenly something shows up and suddenly you have an edge. You understand things better than the rest of the world does, or you've done a drill down which has helped you understand it better than the world does. And then, as Charlie would say, you go all in. And so those opportunities come few and far between. Usually they don't last for that long. And so it's a game of extreme patience with extreme decisiveness. And so that combination of extreme patience with extreme decisiveness may not come naturally to a lot of humans. And so I'll stop there. Longer preamble than I wanted, but I just think that it's an area where when I look back at my own investing journey, I can see that there were these moments, not that many, in the last almost 30 years. Um, and it was obvious that you had to step up to the bat and go big.
And thank you, because that video of Warren Buffett talking about book not having taste memory in 2007 was the reason why I went into the world of investing. Literally, that was my light bulb moment. Okay, I want to ask you, in all of this, the common thread really is talking about how difficult it is to actually estimate intrinsic value, right? When Buffett bought Coca-Cola, I think all the analysts were bearish. Everybody had a price target that was nowhere close to what the intrinsic value of the business was and is today. You had incredibly smart people looking at the stock. People want to make money, who are very motivated to make money. And yet the analysts missed estimating the intrinsic value of Coca-Cola. I want to get a sense of why possibly you think it is like this, because effectively we're just doing a future, present valuing future cash flows, getting it to a present value, and then saying, okay, that's what it's worth per share. Yet, even with the same data, the same information, people are missing it. And there must be plenty of stocks today, which, especially in the smaller market caps, which are just not being priced correctly. So I'm curious. I know you've studied people. I know I know that you've been really disciplined about trying to understand this. I'd love to get a sense of why you think this is that put 10
Yeah, so
analysts.
I think once you do the work, um, the intrinsic value would be very obvious. So basically, I think that when Warren and Charlie looked at Coke, it would not have taken them that long to figure out that there was a huge gap between price and value. And but they wouldn't have been able to figure that out if they hadn't had the experience with C's. And if they hadn't had the experiences of many other things, like they understood the notion of buybacks, they understood the notion of capital allocation, they understood how. So one of the things that Roberto Goizueta was doing was he was separating bottling from the syrup business, bottling from the concentrate. The two businesses. He was basically separating them out, and the concentrate business, which is the one that Coke is in today, that's like a software company. Basically, product you create for $1 gets sold for $5 or $10, and you can keep increasing the price on that. And so I think that when they understood, in terms of human population and in terms of countries and in terms of where Coke was in its trajectory and all of that, and they looked at that whole equation from where Coke was in '88, they saw a huge multi-decade runway. That runway, so now it's been like, 36 years since they made that investment. And that runway is still going strong. And if you look at a business like Geico, for example, when Berkshire took control of Geico had 2% market share of the auto insurance business in the US. It's a double-digit market share now, and it's knocking on the door of the the second largest or the first largest player, and so on. So basically, once you have these, you will have aha moments. Many of them will end up being fake aha moments, which means that you go a little further into the rabbit hole and found, well, no, we don't really have what we were looking for here, which is fine. But you will run into some where you go down the rabbit hole and you find that you are able to see things that almost nobody else can see. And that particular nuance of being able to see something so clearly that the other 6 or 7 billion people on planet Earth cannot see, by definition, is going to be a rare event. But it does happen. If you put your nose to the grindstone and you set conditions and criteria and you do the work, you will find inefficiencies and you will find anomalies, and then you can take advantage of those.
I'll come back to this part of the discussion later, and I'll let the questions come in at that point. But this weekend you were attended the memorial service for Charlie. As I was mentioning earlier, we were actually really lucky. Charlie had confirmed that he'd be speaking to us in January of this year. It's the happiest day of my life when I got that email. But of course, sadly, he passed away. I want to know, learning about Charlie and spending time with him, getting to know his friends as well. Give us a sense of what you took away, and especially with the undergraduates and graduates on the call. What were the one or two things perhaps that you think you'll carry with you and you want generations of your family to be also knowing?
Well, I think they broke the mold after they made Charlie. So we are not going to ever have another Charlie Munger. So Charlie was a very unusual person from a number of fronts. In one of his last interviews, I think someone asked him, what would you like on your gravestone? And he said that I tried to be useful. And I think that's really exactly how Charlie went about his affairs. He was trying to be useful um, till the last day, 99.9 years. And um, there's a book that came out a few years back by Adam Grant called Give and Take. And basically, Adam Grant said there are three kinds of people in the world: givers, takers, and matchers. So the givers just, help out other people without expecting anything in return. The takers who you want to truly avoid in your life are the ones who want to just take from you without giving anything back. And the matchers are the ones who like to keep kind of tabs. Oh, he did me a favor. Let me try to do the same kind of favor for him. And they feel good about that. You want to eliminate the takers and the matchers from your life completely. And you want to be surrounded by givers. And you want to yourself be a giver. And this year, when Buffett wrote his letter, he pointed out that in 65, when he bought Berkshire Hathaway, and Charlie told him he had made a mistake by buying Berkshire Hathaway. And he said that it's okay, you made the mistake. I'm going to try to help you fix it. And Warren said basically Charlie had no ownership stake in Berkshire at the time. There was no plans for him to have an ownership stake, but he was going to selflessly help a friend, right? And the selfless helping of a friend led to about 11 or 12 years after that, or I think 11 years, when he became vice chairman and formally became a partner with Warren in the further evolution and creation of Berkshire. And of course, the rest was history. So the thing about, I think the one lesson is that you want to be a giver. You don't want to be trying to keep some scorecard, and you don't want to extract from the world and try to be smart about it, because the world will figure that out. So I think that was a really big lesson for Charlie, is that Charlie tried to be helpful to everyone he encountered in any sphere of his life. So he was helpful at the Good Sam's Hospital. He was very helpful to Costco, where he was on the board for 27 years and never missed a board meeting. He was obviously very helpful to Berkshire, and he was helpful to countless students with all of the zingers and one-liners and all his writings and speeches and everything else. He tried to help investors become better, and left us a mountain of material to go through. So I think that's one of the lessons. The other thing about what I learned more from observing Charlie as opposed to direct words he would have said to me. I mean, he said a lot of words to me, and he helped me in difficult times in my life quite a bit, which was great. But what I observed about Charlie was that every time I'd see him, he was focused on a couple of problems he was working on at the time. And those problems took 200% of his attention. So I try to remind him about his legacy. I try to remind him about the huge body of work that he had created and all these accomplishments in the past. And he would brush it all aside. He was not interested in even thinking about all that or talking about all that. What he would be focused on is, like, he was searching for a CEO for Daily Journal. He was trying to find a successor there, and he had his energies focused on that. Or, for example, when he was designing the dorms for UCSB, I mean, I'd go meet him. He'd be working on the plans, and he would ask me questions like, how tall is the F-150 truck? I'm building a parking lot. I want to make sure the F-150 can go through. I don't want to have a too high a, thing. So, he was just constantly very focused on the the topic at hand in front of him. And I think that's another big lesson is that we humans tend to waste a lot of energy on looking back, on looking around. And Charlie basically was trying to read as much as he could, uh, put as much great content into that incredible brain of his, and then the lattice work synthesizing of that was just incredible. I mean, I would bring up questions to him about Dakshana, where I was sitting on a fork in the road, and I'd been noodling on this and I didn't know the answer. And before I had even finished articulating the question, he'd already answered what the solution was. And I said, well, why didn't I think of that myself? It's so obvious. And he doesn't know India and doesn't know all these things, but his answers are right on. And that's because he was, pounding so much into his brain, and it was filed in a manner where the lattice work of mental models was full on. He was able to pull from different models and so on. So it was just great to see that in action. And we've seen that in action at the Berkshire meetings. Warren will be rambling for 5 or 10 minutes and Charlie will give a one-line zinger, which is more effective. So that's the way it is.
Thank you. I don't want to ask too many further questions. We should open up the floor to questions. By the way, Monish, how are we doing on time? When is your stop time? Do you have to stop in 20 minutes or can we go a bit further?
You guys are more on a clock than I am. So it depends on your attendees because they may have more things going on than I do.
Sure.
So,
Okay.
so you decide when you want to end it.
Okay. So I'll open up the floor to questions, but while that's happening, I want to ask you about Dakshana because I've studied it. And I was actually really happy to see Prem Watsa as a notable contributor. I visited the Fairfax offices just a few days ago. But I want to ask you about Dakshana and your vision for it. Because to me, this looks like you're investing in it and this is going to be your masterpiece. Have I thought about this correctly, or is this just an experiment for now?
Well, I mean, I think that in philanthropy, the rules are different.
Hmm.
So in investing, we try to go low risk, high return. We try to minimize risk as much as we can, and we try to maximize the return as much as we can. We want a huge delta in those two. If you want to make a difference in this world on the philanthropic side, you have to go high risk, high return. So it's a lot more like venture capital. And it's a lot more swinging for the fences. So the correct way to approach philanthropy is to go very bold uh, and not be concerned if there's a high probability of failure. What you really want is that that if it works, it moves the needle in a major way. And if it doesn't work, it's okay. So, for example, the Gates Foundation for decades has spent a lot of money on vaccine development. And so far, they have nothing to show for it, right? But the thing with these vaccines is that if we get a malaria vaccine or some of these other um, ugly diseases humans deal with, it changes the game. I mean, the polio vaccine changed the game. The smallpox vaccine changed the game. And so vaccines are an example of that high risk, high return type approach, right? And so when I started Dakshana, um, we were definitely going to go high return for sure. And I wasn't really concerned about whether we would be successful or not. And I did not know whether we would be successful or not. And I actually didn't care. It was irrelevant. So the way Dakshana was designed, so I am the shameless cloner, not just a cloner, a shameless cloner. And before I started Dakshana, and I actually discussed this with Warren, Warren had just set up his giving where he was giving 5% of the Berkshire shares he owned every year to these 4 foundations, 5 foundations. And So let's say he had 500,000 shares of Berkshire to start with, right? So the first year, 25,000 shares went. The second year, it would be 5% of 475,000. So each year, the number of shares given is going down. But because Berkshire's intrinsic value is increasing at more than 5%, the amount he is giving each year on average is going up, right? And basically, if he lived for 1,000 years, he would still be giving away money, in effect, because the compounding is more than 5%. So I said, oh, this is a really good formula that Warren's come up with. I'll clone this formula. So in 2007, when our net worth was over 50 million, I said, okay, I don't want to wait till I'm 70 or 80 years old to start giving money away. I'll give away 2% a year. Okay. And above 50 million, 2% was at least $1 million. And $1 million gave me enough ammunition to do something meaningful. And my idea was, okay, in 2007, I think at that time, the giving was 1.3 or 1.4 million or something that year. Um, I was perfectly happy if the money got torched, okay, and nothing came out of it. And in fact, when I was going to do this in India, I was a guy in shorts in California who was running an investment fund. I was not going to move to India. I was going to have to rely on a team that didn't exist, leadership that didn't exist, a corrupt country, all kinds of issues. So I fully expected that every year, whatever money we would put in would just disappear. Nothing would happen. And I felt like in 10 years of doing that, beating my head against the wall, I would learn something. And possibly in year 11, we would get some traction. Okay. After 10 years of hitting a head against a brick wall. That was the plan for Dakshana. What actually happened was we got traction in a few weeks. I ended up finding great leaders. I found by accident a great model. The model worked. The partnerships with the government of India actually came about. So all kinds of unlikely things that should have not happened actually happened. And we never wasted, I don't think Dakshana spun its wheels and lost even $10,000. And so life is great. Better to be lucky than good.
I'm looking forward to Dakshana because I secretly feel like the way you structured it, going to the annual report, there's much more coming out of this. So I think this is something that's something that I'm actually going to follow and see.
Well, we're gonna keep swinging for the fences, and sometimes we will miss, and that's okay.
That is
No
indeed.
problem.
Um, at
The ROI, the social return on invested capital at Dakshana is so extreme
Mm.
and so so off the charts that even if we become extremely sloppy on the next 5 ventures we go into and they
Yeah,
fail,
yeah.
we would still end up okay. So life is good.
No, I think the present value of what you're doing and just the present value of lives you've touched is something that's extraordinary. Would you have any questions at the moment, Francis? No. Okay. So while the MIT students are getting their questions together, you spoke about in one of the interviews you spoke about Fiat Chrysler and understanding, spending a few months going a mile deep in that industry. You came to understand Sergio. His surname is a bit different.
Marcioni.
Marchione.
Yeah.
In better detail. You've spoken to a number of company managements. By default, CEOs and CFOs tend to be good with people. They can convince people. So what exactly have you seen that makes an exceptional management or a CEO or a leader? Number one. Number two, how did you go about actually digging in and going a mile deep? Like you start with the 10Ks, the annual reports. Do you call up the investor relations teams? Do you go through the transcripts? But beyond that, what else do you do? How do you become an expert in that field, perhaps better than most other investors?
Yeah, so first of all, to figure out the nature of management and the competence and capability of management is relatively straightforward. Um, don't go by what they tell you, what they say is going to happen. Just go by what's actually happened. So if they've been around for 10, 15, 20 years, it's easy to look at the track record. So we can go back. So with Sergio, there was a very long history. There were a few cases Harvard Business School had done on him. And there was even a book about him, not about him, but it covered him, Mondo Agnelli, which was on the Agnelli family, but they covered Sergio. So actually, when you went back and looked at the body of what had happened in the past, there was about 8 years of history of him being at Fiat. And Fiat had cycled through 5 CEOs in the previous 12 months before Sergio came on the scene. And Fiat was on life support. They were losing more than $1 million a day. They had no money. Basically, the equity was gone. The banks were, kind of closing in. All the walls were caving in, and it was a business in very deep trouble. And Sergio came in, and I just studied kind of what he did and how he did it, and he learned a lot from Lee Iacocca, and he took the Lee Iacocca playbook and basically replicated it. And what Lee Iacocca had done, which was again when Chrysler was in deep trouble, is he got rid of all of his direct reports that he inherited. He went deep into the organization, sometimes 3, 4, 5 levels below him. And he pulled a bunch of 30 somethings, about, 7 or 8 30 somethings, and promoted them to be his direct reports. And basically, there was this new young team, and they hit it out of the park, right? I mean, it was a very calcified business. And I think Sergio looked at Fiat very similarly. He was a good judge of people, and he was a great manager. So it was very easy. I think when you started diving in, if the question was, what kind of leader do we have here? It was very clear relatively soon that we have an extraordinary leader over here, because he had already delivered incredible, miraculous results in the past. And the Fiat Chrysler merger had already taken place 3 years before that. So there was a lot of trademarks over there as well. It wasn't like I was coming in when the merger was being contemplated, et cetera. They had already, it's a big undertaking to bring these two companies together. And it had been highly successful, that integration, and it was still embryonic, but it was going. And Sergio actually had given 5-year plans. He was telling you what was going to happen in 2017 and 2018. And what he was telling you was going to happen in 2017 and 2018 made Fiat Chrysler less than a PE of 1. Okay. No one believed him. No one believed when he actually put it black and white in his presentations. Guys, this is my guidance for 2017 and 2012. Okay. Nobody does that in the auto business. Okay. Elon does it, but he misses them usually, but that's okay. But basically, so I think just like with Coke and Geico and others, once you go down the rabbit hole and you find that there is meat on the bone and you keep digging, basically the answers will keep coming. So any question you have, these were such well documented, well followed industries, long histories. And Fiat Chrysler at the end of the day was a really simple business. They had the Ram franchise, which was bulletproof. It was an oligopoly. They had the Jeep franchise that was bulletproof. They had the minivan franchise that was bulletproof. The rest of it they could just toss in the garbage. It didn't matter. And then they had 80% of Ferrari, they had Maserati, Alfa Romeo. So when you started to, put the pieces together, the market cap was 5 billion and Ram was going to produce more than 5 billion a year in cash flow. And Jeep was going to produce more than 5 billion a year in cash flow. And then everything else is going to produce something, So it was very easy to come up with valuations, which was more than 10 times what the stock was. So it was simple.
All right. And we'll see you on questions, but we have Yapkal who's got a question. Yapkal, do you want to go ask your question?
Hello, yes. Hi, my name is Yapkal. I had a question from the conversation as like a new investor. Personally, you've talked a lot about like finding an edge and going down this rabbit hole when you found something that's abnormal or something that's like meaty. But I guess my question is like, how do you know that something that you found is really an edge? Like, what makes something an edge, or like what makes it? So how do you know the difference between if this is something that's specific to this certain company or this specific setting, like within how you talked about the C's Candy Company, where like their business model, it fit mainly California's ecosystem and their growth, but it didn't extrapolate to other places. How do you differentiate those kinds of ideas, and how do you identify what is extrapolatable in those kinds of like areas?
So actually, you have a big advantage over me
Mm,
in finding those great nuggets and those great future opportunities. The reason you have an edge over me is because you are young and you are in a place where there's a lot of change taking place.
mm,
And so, for example, um, landlines, which you may not know what a landline is, that's okay. But
mm,
the first people who disconnected landlines were college students. Okay,
mm,
so there was a time in this country where everyone had a landline phone,
yeah.
right?
Mm,
Like if you watch Seinfeld, you might see a landline phone.
yeah.
Okay, and it was at the college campuses where the cord cutting on landline phones happened first, and it came much later to um, mainstream America.
Mm,
Okay, that was a very gradual kind of 20-year transition. It used to be accepted wisdom that 2% of the population would subscribe to cell phone service. And once you reached 2% of the population, you were at saturation because cell service was so expensive that nobody beyond that 2%, and also, so just the infrastructure and all of that, it just made it hard. We are at 100% today, right? Or close to 100%. So Facebook started on the Harvard campus, and it was only for Harvard students initially. And then they expanded to other Ivy League. MIT was probably right there, probably the top 4 or 5 campuses. And
mm,
so the students at Harvard, the students at MIT knew what Facebook was all about at least 8 or 10 years before the rest of the old people like me. Okay. There was a huge advantage. So, what I'm saying is the thing that you should do, make a list of every product and service that you have consumed in the last couple of years. So, what brand of clothing are you buying? What perfumes are you buying? What online services are you buying? Make a list of every dime. Do you go to Sweet Green for lunch? Do you go to Chipotle for lunch? So the college students were the first to go to Chipotle. They knew about Chipotle before the rest of the world a long time ago. So if you made a list
yeah.
of everything that you spend anything more than 5 cents a month on.
Mm,
Okay. It's very difficult for a company to convince you to even give them $1 a year or $1 a month. It's very
yeah.
difficult. They have to really prove themselves, and there has to be something there. And if you made that list and you put it away somewhere, so you make a list of all the publicly traded companies that are products and services that you are using today. And if you fast forward 10 or 20 years, and just look at that list, there will be 50 baggers from that list. And so there's already a short list you have.
Yeah.
And now you just have to do work on that short list. And I can't do that, but you can. You
Yeah.
have a big edge.
Okay. I'll be sure to take that advice. Yeah. Thank you
All
so
the
much.
best.
Thank you.
All
Monish,
right.
we have a thing called the Visiting Fellows Program. You can come in for 3 months and spend time on campus, and so just putting it out there.
It
Okay,
might help. It might help my wealth situation.
we have 3 questions from the Q&A chat. One is from an anonymous attendee. And by the way, Yapkal, sorry, did I cut you off? Did you have? Okay, no, that's okay. Thank you for sharing your time generously. Can you share your perspective on the impact of AI and how managers run their companies? What are some of the areas they should watch out for? But just generally, even in the investment world, I mean, AI is just huge. How are you thinking about this and what have you seen so far?
I am the wrong person to ask. You should ask your fellow classmates. So, all the action that's happening in AI and all the changes that are happening in AI and what's going to change in the future, the MIT campus is front and center. How can me sitting in Austin hold a candle to that? So I am so set in my ways and so hosed in so many ways. And so I'm the wrong guy. I mean, from a periphery point of view, I can just see that there's transformational impacts everywhere. There's so much happening, and there's so many different. Uh, just today, one of my friends was telling me that there's some AI app where it's able to take like they outsource some work to India, but when somebody in India is talking about something in an Indian accent, this product will change it to a Native American, a local American talking in an American accent. And the AI will just switch that whole thing to whoever's voice you want. So you could have, Morgan Freeman, for example, doing that for you. And so what I'm saying is that there's all these things that are happening at such a pace, and it's so fast. And even like, for example, the stock photography business, the images being generated through AI is unbelievable. I mean, the thing is that it already probably obsoleted the stock photography business. So I think that I think you guys are, MIT Media Labs and all of that. I think you guys are so far ahead on that. So that's a great area to just look at what's happening on the campus.
And here I was just remembering when somebody asked about Buffett investing in cars, they said I knew at least I should short horses. But here it's like you have to short almost everything because like the world is going to change in 10 years, 5 to 10 years because of this.
Yes.
The next question comes from Aruja Khanna. Thanks for coming, Monish. I just want to know more about if you try to strike a balance between financial return and impact at the Dakshana Foundation, or is it if it's focused on social impact solely? If you were to try if you do try and find a balance between both, and then how? I think you've kind of answered this.
Well, I would just say that you want to have separation of church and state. So I don't think you want to mix investing with saving the planet. And a lot of people try to do that. So I think that when I'm looking at philanthropy, I'm looking at philanthropy. When I'm looking at investing, I'm looking at investing. And the two shall never meet. So it's two separate activities and two very different mindsets. And I think trying to combine them in any way is not going to get you to the promised land.
Okay, but just Aruja's second question was also really interesting. She said, or he said, sorry, it would be great to know a bit about an interesting aha moment in your career in investing. What was the one thing that just like, yeah, hit you and you're like, okay, this is something.
Well, I mean, I think the aha moments come, like, for example, when I was studying Fiat Chrysler, uh, at the time when I started to study it, I had deep hatred for the auto business, extreme hatred. It's unionized, it's high capex, it's subject to consumer taste. You may spend 3 billion trying to develop a car and nobody likes it, and so on. And it's so much of it is commoditized and so on. It's a lot of ugliness in the auto business. And the reason I went down the rabbit hole is I saw that Ted Wexler uh, had made an investment in General Motors. And I think I saw that David Einhorn had made an investment in General Motors. And I said, why would these two smart people invest in such a horrible industry that we all know obviously is horrible? So I said, I only went down the rabbit hole to try to answer that question because I said, it makes no sense to me. So actually, one of the things in investing is when things do not make sense to you, you have to stop yourself and take some notes and say, I think I need to go down this rabbit hole. So, for example, Seinfeld wrote a book. The audience doesn't understand Seinfeld, which is very unfortunate. But Seinfeld wrote a book, which I thought was a great book. Is this something? Okay, or something like that is the title. Is this something? Every day, he sits down for an hour with a yellow pad thinking about anything that he's encountered in his life and day-to-day encounters, which could be weaved into a story for stand-up comedy, right? So humans have all kinds of things going on, which, if you really stop to think about it, they don't make any sense. Like, for example, there was an episode on Seinfeld where he goes to a car rental place at the airport, and he says, I have a reservation, etc. And they tell him, I'm sorry, sir, we don't have any cars. So he says, I have a reservation. He says, yes, we have your reservation, but we don't have any cars. So he says, well, if you have my reservation, you have to have a car, right? And so that whole thing became an episode, right? Because he just noted down that sometimes people have a reservation and they don't have a car available. And how do you kind of correlate that? Or one time there was a episode about George's very thick wallet. He had a super thick wallet, right? And so again, there was a whole episode on that. So I think the thing is that he's writing down anything that looks like an anomaly or weird things about humans to him, right? And most of those may not pan out into something that turns into some great 10-minute or 15-minute, stand-up routine, but some of them will. And so the discipline of sitting down every day. So anytime you encounter something that makes no sense to you. So when I encountered David and Ted Wexler on GM, it led to the work on Fiat Chrysler, and which was a huge home run. And of course, now one of the problems that came about in that huge home run was I missed it. The biggest piece of that home run was that Fiat Chrysler owned 80% of Ferrari. And I didn't even care that much about the value of Ferrari because I was focused so much on these other pieces, which were going to make the market cap in earnings in a single year. And Ferrari was making $250 million a year. And I said, okay, so it's worth like 3 billion, 4 billion. if you want to be really excited about it. But so what? 5 billion. Here we're going to have the rest of the business be worth 40, 50 billion. So I didn't care about Ferrari, but actually Ferrari was I had a good return on Ferrari. I think I made 5, 6 times my money. But the big mistake I made was it should never have been sold. From then till now, it's almost a 25 bagger. And it's 25 bagger on a $20 million investment is about 400 or 500 million. And so that's more than chump change. So even I missed it, even in that scenario when I was looking at this thing so carefully for so many years. So I think that is the business we are in. We are in the business of drilling down on anomalies. Just like I told the student, her job is to look at every public company that she is giving even $1 a year to and drill down on those.
So as Buffett and I think said, focus is the most important thing in this business, right?
Yeah.
So we have one last question from Tony Tian. It says, "Hi Monish, thank you for sharing your insights with us. Considering the significant impact of political events on investment climates, and with at least 64 countries representing about half of the world's population expected to hold national elections this year, how should one navigate and capitalize on associated risks and opportunities in the 2024 investment landscape? Additionally, in your view, do the political lessons and public sentiment outweigh financial fundamentals in these scenarios?" I think I'll add to this your Turkey play.
So it's the wrong question and the wrong way to approach it. You need to start with a business. You don't, it's a big mistake to start high level and try to go down. That's just not a good way to go about it. I had an interest in Turkey because there was a lot of dislocation at the time and it was hated and unloved. But immediately after when I made my first trip to Turkey, my focus was on meeting companies. And I was just going there to understand what these businesses did. And I love figuring businesses. I didn't care whether we made an investment in Turkey or not. And I didn't really know. I didn't even think we would ever invest in Turkey. But basically, I probably in the last few years visited probably 70 or 80 listed Turkish businesses. And I didn't really care about the macro, whatever was going on. It was there in the background. What I was looking, everything was on sale. Everything was very cheap. What I was looking for is the greatest businesses that were immune to any of the macro things that are going on. So for example, if we have a Coke bottler in Turkey, or let's take a more extreme situation because Turkey is too Mickey Mouse to talk about Coke bottling. Let's say we have a massive thermonuclear event in the world. Thousands of warheads go off. Instead of 7 billion humans, we're left with 2 million humans. The human race is basically almost wiped out. Okay? Somebody somewhere will start bottling Coke. Okay? The currency will be gone. Everything will be gone. I don't really care if it's seashells, but a person will be willing to trade some amount of their labor for an 8-ounce serving of Coke. Okay? So in a thermonuclear event which wipes out 99.99% of humanity, Coke is around. So are we going to really care about the Turkish lira? No, completely irrelevant. And so when I invested in the Coke bottler and when I started going to Turkey 5 years ago, it was 5 lira to the dollar. Now it is 32 lira to the dollar. All our investments in dollars are up massively. all Mickey Mouse, didn't care about the macro. All I cared about is that if you have a Coke bottler, people will be willing to trade certain amount of their labor for a 8-ounce serving of Coke. It doesn't matter what the inflation rate is. Doesn't matter what the exchange rate is. Doesn't matter what anything is. So we start with a business.
That's pretty cool. Now, I have one final question for you, Monish. Describe a day in your life. I think I've gone through all the interviews that you have on YouTube. I've gone through everything else. I'm really curious. I'm genuinely curious. Like, okay, what is a day in your life? I see all the books behind. How much do you read versus how much do you talk to people on average over, let's say, a 6-month period? And how do you kind of condense this down in your mind, and how do you ultimately decide, okay, this is because you're going to have competing information coming from everywhere, opinions, all sorts of information flows. So walk us through this. And I'm curious. I really am curious about this.
The only meeting or business thing on my calendar today was this event. Okay. And I don't think there's anything on my calendar tomorrow. And basically, one of the things I learned from Warren and Charlie is be extremely good at saying no. So I say no to almost everything. I especially say no to anything related to a call or a meeting or anything like that. So when I wake up in the morning, I don't want to have a predetermined agenda of, okay, this is my schedule for today or any of that. I don't want that. I want complete free form. And so then I can decide, okay, are we in the middle of a rabbit hole and we can keep going down that rabbit hole, or are we looking for the next rabbit hole, or what do we want to do? So it's very flexible how the time gets spent. So the reading, I love to read. The priority always is investment reading, right? So if I'm looking at a business or something, then I've got a lot of things to look at and read. But in the lull periods, when we don't have exciting rabbit holes, then we've got books that we can read and such. So probably I may have read a quarter to a third of the books in my library. So there's plenty of stuff on the shelves that I haven't gotten to yet. So I can always wander in any area into any subject and pick it up. And I'm a harsh grader, so a lot of books don't get finished. One of the things I found curious is Bill Gates says that once he starts a book, he has to finish it. And I would be just so hosed if I had to do that, because most books should be 5 pages long and they are 300 pages long. And all the content is in 4 or 5 pages. And I'm trying to get to those 4 or 5 pages of content that some idiot has buried somewhere. So yeah, so if a book doesn't grab me after a few pages or 10, 20, 30 pages, I may move on to another one and keep going from there. So basically the idea is that, and I think Buffett and Munger try to operate very similarly. I saw this with Charlie especially. I think Warren is very similar. Even though all those people in headquarters, I mean, he has his door closed and he's just reading and doing his thing or whatever he's doing. And he guards his schedule very carefully. He doesn't put stuff on the schedule. So I think less is more. It's really important. So if you work backwards, where if you say, okay, someone says to you, you were 90 years old and yesterday you died, and pretend you're your best friend, and your best friend's going to write your eulogy, and they're going to present this eulogy in about 5 minutes. So it's like a 1 page or 1.5 page long to your close friends and family. Okay. And they're going to talk about whatever happened in your life and how great you were and all of that. the question to ask yourself is, if something's not going to make it in your eulogy, why are you spending time on it? So I think Buffett and Munger, what I noticed is they were really, really good at getting to the essence. And so there's a lot of wasted time with a lot of humans. People want to meet for lunch or meet for coffee or whatever else is going on. And I think that just takes away focus.
But
So I'm sorry to disappoint you. There's just not much going on, just the way it is.
no, and that's a wonderful point actually to bring the call to a close. I just have one last favor. If you have a reading list from all the speakers that we're trying to get a reading list. So if you have a recommended reading list that you share out, we'd be most grateful for you if you could send that to us.
Okay.
And just Monish, it's been a journey of over a decade for me to get this call. So I just wanted to say thank you. I'm deeply grateful to you. And from all of us here, we're just super grateful and lucky to have had this opportunity. So thank you.
Well, you're at a wonderful institution, amongst the best in the world, if not the best. And I think it's a great place to be. And everything that's going to change is happening there. So you're at a front row seat on all of it. So you can uncover very big fortunes by just asking, what is that? And where's that going?
A side fact here is we actually have access to Moody's manuals from 1909. So all of them.
All right, that's great.
Slowly, I'm trying to get my head around. It's a slow interface, but
that's awesome. Well, thank you for having me. It was wonderful. Thank you.
Thanks, Monish, and look forward to seeing you soon.
All right. We'll talk to you later. Bye.
Thank you. Bye.